In this video, we'll discuss when to use higher time frames. Higher time frames can improve clarity and confidence, but many beginners don't know when to use them. Let's simplify this. You should use higher time frames to understand direction. They show the bigger market structure. Trends are clearer on higher charts. Noise is reduced significantly. If you feel confused on a lower time frame, zoom out to a higher one. Confusion often disappears when you zoom out. Use higher time frames to mark support and resistance. These levels are stronger and more reliable. Daily and 4-hour charts are very useful. They provide balanced perspective. Higher time frames are also helpful for beginners. They reduce emotional pressure. You don't need to react to every small candle. Decisions become calmer and more logical. When markets look choppy or random, check the higher time frame first. Often, a clear structure is visible there. However, higher time frames are not for quick entries. They guide direction, not exact timing. Use them as your strategic view. Then move to lower time frames for execution. This creates alignment in your trading. Alignment increases probability. But remember, keep it simple. Do not use too many time frames at once. 2 are enough for beginners. 1 for direction. 1 for entry. Higher time frames build patience. And patience builds discipline. Quick recap. Use higher time frames for trend and structure. Use them when confused on lower charts. They provide clarity and perspective. In the next video, we'll discuss chart clutter versus clean charts.